morning, everyone. Thank you so much for joining us today. My name is Tracy Campbell, and I'm a Chair Support Advisor here with TEC Canada, and I'm excited to welcome you to this latest TEC Canada Deeper Insights webinar. Today, we are delighted to be joined by Elli Schochet, CFP and Managing Partner of L.G. Brown & Associates and a TEC Canada member. Since 1943, L.G. Brown & Associates has been providing insurance and financial solutions to Canadians. As the managing partner of the firm, Elli specializes in providing innovative strategies to business owners and professionals to help them manage their financial risks and tax efficiently transition their wealth intergenerationally. Elli has been a certified financial planner for the last 20 plus years and is recognized as one of the leaders in the insurance industry. He is a member of the Conference for Advanced Life Underwriting and has spoken both in Canada and the United States on succession planning and intergenerational wealth transfer strategies. Remember, all TEC Canada Deeper Insights webinars are interactive. Whether you're joining us on Zoom or on our social media streams, share your questions and comments in the chat to receive personalized insights from Elli throughout the webinar. Without further ado, let's dive into the hidden tax opportunities of life insurance for Canadian business owners with Elli. Welcome, Elli.
Thank you so much, Tracy. Good afternoon, everyone. Good morning to those in the West. I'm delighted to be here this morning with you to talk about the hidden tax opportunities for Canadian business owners using life insurance. I'm really passionate about this subject because it's what we do each and every day. And frankly, in Canada, we are overtaxed. I don't want to depress anyone, but let's just start to look a little bit at our tax system. First of all, I'm going to, for the most part, talk about Ontario, but this really applies across Canada. Income taxes, the top rate for income tax is actually 53.53%. The small business rate for corporations whose income is under $500,000 is 11.5% tax, and then the corporate business rate is 26.5% tax. Passive investment rates in Canada, right, for business owners that are investing in their corporation, passive investment rate is 50.17%. The dividend tax rate, if you pull money out of your corporation, is 47.74%. Capital gains tax is 26% if you sell anything and you have a gain. And of course, let's not forget about probate taxes. Throughout our business cycle, we are taxed significantly. And life insurance really gives us some opportunities to save tax. And today, really what I want to do with you is share some ideas and insights with you to help you to understand how you can grow your money in your corporation and pass that money on to future generations at significantly lower tax. In fact, some of it going completely tax-free. We're going to be speaking specifically about life insurance because life insurance has very unique characteristics in that it has tax-free generation of tax. But what I want to do before we get into that is really to start to dive into life insurance as a whole, and then we'll start to look at some of the strategies that we can utilize. At L.G. Brown & Associates, we have a team of 20 people that really help us to design and implement strategies. And what we really do is we help individuals and their families use their wealth to fulfill the purposes they value most. What I mean by this is each of us in our business and in our life has purpose that we're striving towards. And what we do is we help our clients use their wealth that they've accumulated to do what they want to do with it, to fulfill the purposes that they value. When we look at life insurance itself needs to be purposeful. There are different purposes for life insurance. Life insurance can be used as a risk mitigation tool. It can be used to grow and enhance our wealth. If you think about it, for most business owners, for most people, at some point in time, you sat down with a financial advisor, with an insurance advisor, and discussed life insurance. And in its rawest element, the purpose of life insurance is to protect your human capital. and it replaces a needed stream of income that's lost in the event of premature death. But as you build your capital, you no longer necessarily need to replace your human capital if you have accumulated enough capital. At a certain point in time, I tell our clients all the time that they are self-insured. As you go along in the business cycle, you get to a point in time where you have grown your assets, that if something happens prematurely, if you have enough assets, you no longer need a life insurance company to come in to replace your human capital because you have your own capital. Effectively, you're self-insured. Now, I'm not telling you that people don't need life insurance once they have been successful and accumulated a lot of money. In fact, it's quite the opposite. There's another reason for life insurance, and that is to protect the legacy of our wealth. So life insurance has dual purposes. The first purpose is to protect the human capital. The second purpose is to protect the value of your net worth from taxes and market risk. As we said before, we're heavily taxed. Any growth that we have in our investment portfolios, right, if it is in income-producing assets, it's taxed at 50%, whether personally or in the business at 50.17%. And then, of course, there's market risk. We have, over the years, seen incredible amounts of volatility in the market. Insurance gives us the opportunity to reduce that volatility. And part of what we're going to be talking about today is how we can use insurance to reduce volatility. Capgemini did a fascinating study. They found that high net worth individuals actually have almost 40% of their assets in safe asset classes. Cash equivalents, fixed income. Then, of course, you have real estate. And then you get into equities and private equity and other types of more risky investments. But as you accumulate your wealth, many business owners who have hit the home run, they take the risk in their business. But once they've accumulated a lot of capital, that investment portfolio may not always want that to be exposed the same amount of risk as in their business. The business is where you hit the home run. The investment portfolio sometimes can be more conservative. There are really a couple aspects to this. We use insurance as another alternative asset class that is extremely conservative and can be compared to cash equivalents. But the other area where business owners need to be concerned about preservation of capital, and the real reason why high net worth individuals are not taking a lot of risk with their investment portfolio, is because they want to preserve the capital. It's no longer about getting rich, it's about staying rich. And you stay rich by being a little bit more conservative in the investment portfolio and not risking what you've made. But you also get rich by keeping more of your hard-earned money from taxes. It's not necessarily what you make, it's what you keep. I want to share with you a fascinating chart that Sun Life did, Sun Life of Canada. Starting about 7-8 years ago, we started to see very large amounts of money across the country starting to flow into life insurance. And the question is, why is this happening? But I'll share with you just some statistics from 2019, and they've just gotten more and more money has been flowing in since then. So in 2019, these are the top 10 life insurance policies that were bought in Canada in 2019. You'll see it ranges from $20 million to $160 million. Now, we've been in business a very long time. I can tell you, if you go back 20 years ago, 25 years ago, we were not seeing these types of numbers flowing into life insurance in Canada. In fact, most insurance companies couldn't write a policy for more than 80 or $100 million. They didn't have that. They didn't have that capability. Today, it's above $230 million, the amount that one life insurance company can write. You have to ask yourself, why is it that so much money is flowing into life insurance? Number one, why are people buying 20, 30, 40, 50, $100 million of life insurance? Number two, why are they spending premiums from $1 million to $12 million a year on life insurance? There has to be a reason that is beyond just protecting the human capital. In fact, it's public knowledge, both was printed in the National Post in 2012. Ted Rogers had $102 million of life insurance. There are different numbers out there, 96, 107. The number that I saw was $102 million. Why on earth did Ted Rogers have $102 million of life insurance? It wasn't to protect his human capital. It was purely for tax planning strategies. He had 12 life insurance policies that he bought over the years. He used part of those policies to help him buy the first radio station that he bought, but he had those life insurance policies to help him to successfully transfer wealth tax efficiently from himself to the next generation. So I'm going to share with you how this works. There are three major reasons, and there are many, many more, why people buy life insurance for tax planning purposes. First of all, life insurance is a guaranteed vehicle. The amount of insurance that you buy initially is 100% guaranteed. It can never go down. We can talk about the guarantees of the life insurance companies. They also have protections under Assurance, which is the equivalent of the CDIC to the banks. Assurance is to the insurance companies what CDIC is to the banks. The growth in the life insurance policies, both in terms of their cash value as well as the death benefit, are tax-free. They grow tax-free. More importantly, they get paid out. The death benefit gets paid out on a tax-free basis. But then there's the magic, the icing on the cake is the capital dividend account. As business owners, we're aware of the capital dividend account because we use a capital dividend account when we sell a capital asset in our business. If we sell stock, if we sell a business, you get a CDA credit. 50% of the capital gain comes out of the business tax-free through the capital dividend account. With life insurance, the death benefit is paid out tax-free into the corporation. And then the corporation can declare a capital dividend account equal to a capital dividend equal to the death benefit minus the adjusted cost base of the policy. And that adjusted cost base of the policy, although it's a complex formula, gets ground down lower and lower and lower the longer you hold the life insurance policy. What are the reasons why people buy life insurance? Well, we spoke a little bit already about income replacement and risk management. But people buy life insurance in order to fund a capital gain. So for capital gains tax liability funding, and I'll share with you the different ways that you can fund a tax liability. When do you have a capital gain? Well, either when you sell an asset, you have a capital gain, but you also have an involuntary capital gain, and that happens on death. You see, the government deems that you have sold all of your assets on the day before you died. If you own a cottage, if you own a business, if you own a building, the day before you die, the government deems as if you sold that building, even though you still hold on to it. And therefore, there is a capital gain attributed to you, and you have to come up with the tax owing on the capital gain. Another reason people buy insurance is for estate enhancements, to grow their estate. It's extremely tax-efficient accumulation because there's no tax on the growth within the life insurance policy. It's considered an asset diversification tool. It's an alternative asset, and we'll explain why as we go through the presentation. And then people use insurance to enhance their retirement plans. We're going to focus today mostly on whole life insurance, but there are really three types of insurance: renewable term, which we often use for that for the risk, for the income replacement or risk management side of things; universal life, which is a product that was used significantly from about 1990 till about 2012. It's still used today, but predominantly whole life insurance is used for many of the reasons that we discussed: estate enhancement as an alternative asset and other strategies. So we're going to dive into it. We're going to talk about whole life insurance and what does it do and how does it work. Whole life provides permanent life insurance. The premiums are guaranteed. Now, the premiums that you pay into the policy go into what's called the participating account. And the participating account, this is Sun Life's participating account. At Sun Life, there's $16.17 billion in that account. It's invested very, very conservatively. The money being invested by the insurance company, usually at a profit. At the end of the year, the insurance company may declare a dividend, which can be used to increase the benefits and build cash value. The amount of that dividend is determined by a number of factors, such as the investment returns of the participating portfolio, mortality gains in the portfolio, expenses, and taxes. So let me dive into this a little bit. The premiums go into that participating account. So as we said, the participating account at Sun Life is $16 billion. The money is invested extremely conservatively. There's private fixed income, government bonds, real estate, commercial, mortgages, corporate. As an asset class, about 63% is fixed income. The equity component is 19%, real estate is 16%, and then the rest is private fixed income, again, mortgages, corporate bonds, government bonds, and mortgages. So the investment income flows into the participating account, and what goes out is expenses and taxes, policy owner withdrawals, and most importantly, death benefits. So policy holders that own a participating whole life policy, their death benefit is actually paid out of the participating account. So last year, Sun Life Insurance paid out $386 million to participating policyholders. It came from that $16 billion. At the end of the year, this is a mini business. At the end of the year, the insurance company meets, the board of directors meets with the chief actuary, and they declare a dividend based on the profitability of the participating account. One factor that they use to take account, to look at the investment component, is they have what's called a dividend scale interest rate. And you'll hear this number, 6%, 5.5%, 6.25%. That's the dividend scale interest rate. And it's one factor that is used to determine the amount of dividends that will be paid out to policy holders. It's the largest factor. And in fact, when we do our calculations, the number that we use to assess the policy is the dividend scale interest rate. So that's the number that you'll hear me referring to when we look at an illustration and the numbers. When they pay out the dividend can be paid out in cash, in which case it's taxable, or it can go to buy what we call paid up additions of insurance. The paid up additions of insurance is an increase in the amount of the life insurance policy. And very shortly, we'll dig into a policy so that you can understand this. Additionally, when you have paid up additions of insurance, so that what happens is the dividend goes and buys additional insurance, and then attached to that paid up addition is cash value. The cash value is extremely important to us because we're going to use that cash value either to enhance our retirement, or we may use that cash value to recoup the money that we paid in premiums using a concept and strategy called the immediate finance arrangement, where we can reallocate the money back into the business that we paid in premiums. This participating account that really is the underbelly of the insurance product is extremely conservative. The yield has been around what I would say, even though it is a fixed income portfolio, it has equity type performance with bond type risk. And the standard deviation, the measurement of risk of the dividend scale interest rate, is less than 1%. Over 25 years, the average dividend scale interest rate at Sun Life has been 7.25%, and over the last year, ending 2022, over 6%. Today, it's increased a little bit. If you compare that to other investment vehicles, the S&P, GICs, Government of Canada bonds, the only thing that comes close to it is the S&P TSX total return. However, if you take a look at the standard deviation and the volatility in the S&P, significantly higher than the participating account of the insurance company. Let's take a look at some of the ways that we can use the life insurance. So first and foremost, this is probably one of the more common uses of permanent life insurance. And for this strategy, we're going to talk about universal life, just for one moment. So an individual has a $15 million capital gains tax. What's the best way to pay this tax? Let's assume that this is a tax that happens in the event of death. So on death, there's a disposition of their assets, whether it's their business or other assets, real estate or other thing. Let's call it real estate. So if you're going to pay this in cash, it's going to cost you $15 million. There's nothing you can do about it. You put cash under your mattress, you pay $15 million. If you don't have the cash, you may have to take a mortgage out because you don't want to sell the asset. The asset, if it's real estate, a building, you don't want to kill the goose that lays the golden egg. So you take a mortgage out. The mortgage, if you pay it over 10 years at current rates, is going to cost you $19 million to pay back that mortgage over 10 years to pay the government the $15 million. If you don't want to take a mortgage or you cannot take a mortgage, maybe you have to sell some real estate. It's going to cost you almost $19 million if you sell the real estate. I apologize for this equivalent pre-tax rate of return. We'll talk about what that is. The last one is if you buy a life insurance policy. So over 10 years, you take $457,000 over 10 years to buy a life insurance policy. At the end of 10 years, it's a universal life contract that's paid up for $15 million. That $15 million is there to pay your tax. What is the equivalent rate of return? We're using an example of a 50-year-old husband and wife who buy, that's going to be our go-to for this presentation. They buy a $15 million policy. They pay for it for 10 years. They die at age 85. The equivalent rate of return, pre-tax rate of return you would have to earn on a fixed income basis in order to match the full 0.5 million, in order to match the $15 million, if you put aside $457,000 for 10 years and then let it grow, you'd have to be earning 9.6% on a guaranteed basis for the next 35 years. The chance of that happening, I'll leave it up to your imagination. So that's one use of life insurance. Now, let's talk about the corporate asset transfer plan. This is a strategy to mitigate the tax erosion on passive investments in a corporation and to multiply the value of the surplus within the corporation that will ultimately be paid out to the shareholders. It's for business owners who have trapped surplus. Trapped surplus is the money in your corporation that you've worked so hard to accumulate. You don't pay that money out to yourself as a dividend because you're paying 47% tax instead of 26.5%, or in a small business, 11.5%. So you have the differential, right, between dividends that you would pay out, 47 and 26. That 20% allows you to grow the money in the corporation, but that is trapped surplus. So business owners are concerned about taxes on their investment income. So if you take that trapped surplus and you invest it, you're paying passive income rates on the investments. The passive income rate is 50.17%. The business owners are looking for strategic asset and tax advantage diversification strategies. Use life insurance, and I'll explain to you why. The reason it's needed, as we said, 50.17% tax. If you pull the money out, it's taxed as dividend or salary, so we need to keep it in the corporation. And there are multiple levels of tax in the corporation. If you're not doing pipeline planning or loss carrybacks, when the money comes out, it could be double taxed. Even if you do the pipeline or loss carryback, you're still going to pay a significant amount of tax to get the money out of the corporation. So using insurance helps us to get that trapped surplus out almost tax-free. And the way we do this is we buy a whole life policy. Corporation funds the plan over a limited period of time, and then you let the money just accumulate. So our scenario that we're going to talk about is our 50-year-old business owner. And I'm going to compare two routes. Route number one is just a regular investment portfolio. So we take $250,000 a year for the next 15 years. We're going to invest a total of $3.75 million. And then we're going to let it accumulate. This is trapped surplus that you're not going to spend in your lifetime. This is money, ultimately, that's going to the next generation. If you've accumulated 10, 20, 30, 100, etc., whatever the number is in your corporation, and you're at the point that you're not going to spend all the money, that money eventually is really going to future generations. So we need to figure out, we know that when the money comes out of the corporation, it's going to be taxed at 47%. Or if you do proper planning, maybe it's going to be 26%. But is there a better way? So if we look at a regular investment portfolio, forget insurance for a moment. You take this $250,000, you invest it, your stockbroker is going to get you 8% on equities, you're going to get 6% dividends. What's it going to accumulate to? And at the end of the day, you pass away. Now that money is ripe to come out to the next generation, to the shareholders. What's the eventual number going to be? We looked at a portfolio. 70% is in capital gain in equities. 30% is in dividend-paying stocks. We're going to assume you earn 8% on your realized capital gains and unrealized capital gains, and 6% on dividends. Our corporate investment rate is 50.17. The dividend tax rate to get the money out of the corporation is 47.74%. Over time, before death, at age 85, that portfolio that you put $250,000 in for 15 years and then let it accumulate will grow to $17 million. You've paid some tax as you go along. You've got CDA that's accumulating. You've got RDTOH, refundable dividend tax on hand. At death, if the shareholders want to pull the money out, they will get out $14 million. The equivalent internal rate of return after tax is 4.76%. I want you to remember that number. Now, we're going to compare that to taking $250,000 and investing $250,000 into a whole life policy for a 50-year-old business owner. We do this on what we call a joint last to die policy, or it can be on an individual policy. For the purpose of our discussion, we're doing a joint last to die policy for $5 million that pays out on the death of the husband and wife or the spouses. The reason that we do it this way is because the capital gains tax is due at the death of the second, or if there is a spousal rollover in the will, the assets of the corporation, the shares of the corporation, are not deemed to be disposed of until the death of the second spouse. So let's take a look at what it looks like when we buy a $5 million policy. And before we get to the end result numbers, I'll just share with you how the insurance policy works, how the dividends are accumulated, how it builds cash value and additional death benefit. We said that we are buying $5 million of insurance. The premium is $250,000. What's guaranteed in the contract is that the $5 million is guaranteed. That's a guaranteed death benefit. The $250,000 premium is actually made up of two components. It's made up of a guaranteed annual premium, which is $102,000, which is really payable for the rest of your life. And then there's what we call additional deposit option. So we're adding in $147,275 to equal $250,000. We're going to pay that for 15 years. At the end of the 15 years, we stop paying premiums and we let the premiums be paid internally on a tax-free basis from the dividends that are paid out on the insurance policy. And just so you should know, we always test this at the current dividend scale, -1 and -2, to make sure that it works. When we look at on a year-by-year basis, at the end of year 1, the death benefit, those dividends, they bought additional paid-up additions of insurance of $503,000. So the death benefit, if both people died at the end of year 1, has grown to $5.5 million. The cash value is $211,581, which is just shy of 85% of the premium that you put in. What you're really doing is you're moving assets on your balance sheet. You're moving it from your corporate investment portfolio on the left-hand side of your balance sheet, and you're putting it into the right pocket of your balance sheet called a life insurance policy. On your corporate balance sheet, every year, your accountant is going to record the cash value. This is an asset of the corporation. You haven't lost that asset. There is a little bleed in the first 5 years. It takes us 5 years until the cash value is equal to the amount that you put into the policy. That means from a cash flow perspective, on your balance sheet, you're still showing the same assets. Now, granted, the investment policy, if you kept the money invested in a stock portfolio, you have more accessible cash, or it looks like you have more accessible cash. But I'm going to share with you a strategy that, in fact, we can use this money for investment, meaning that we can put this policy up as collateral. This is called the immediate finance arrangement, and we'll speak about it in a few minutes. You can access this cash and redeploy it back into your investment portfolio or back into your business. What you can see is that the death benefit grows over time. By the time you reach age 65, it's almost $14 million. You started at 5, you're at 13.79 at age 65, but you stop paying premiums, 13.5 at age 65. You stop paying premiums at that point in time, but your policy continues to grow. And you're no longer paying premiums, but you have this huge asset. You also have cash value of $5.3 million, which you can access to enhance your retirement, either by the way of withdrawals, which are taxable, or you can go to the bank and use this as collateral and borrow money against the policy, either corporately or personally by paying. You can borrow personally by paying a guarantee fee to the corporation. As always, anytime you're doing tax planning, you must speak with your accountant and advisors to get tax advice. So let's look at the effect of this policy. We look at this at the current dividend scale and the dividend scale -1%. So let's take a look at this. $250,000 going in for 15 years, you save $3.75 million. Your death benefit at age 85 at the current dividend scale is just shy of $19 million, and at -1 dividend scale, just around $14.5 million. Your internal rate of return, cash on cash, meaning what would you have to earn on an equivalent investment to equal this before we talk about taxes? 5.85%. Now remember, our investment portfolio was 7.4%, 7.40, but after tax was 4.74. This is 5.85 at current, and in an adverse environment, 4.88. So it's higher. But in reality, you would have to earn north of 10% on a fixed income asset in order to equal what you're going to earn over here. So I'll share with you on this. What does it look like? So let's say your investment advisor tells you they have a MIC, a mortgage investment corporation, that's paying 10% on its money. So this is an alternative investment. You take $250,000, you put it into the MIC, you earn 10%, that's $25,000. You get $25,000. Guess what? You pay tax. So the government takes $12,500. You're left with $12,458. So the balance in your corporation is $262,458 at the end of year one. We keep doing this for 10 years. At the end of 10 years, 15 years. At the end of 15 years, you have $5.6 million that has accumulated. What happens if you die at the end of 15 years? How much is left to your estate? $3.5 million. That's crazy. It's less than what you actually put in. And that's taking into account refundable dividend tax on hand. That's in a fixed income environment. And I understand that many of us may not invest in fixed income. But you have to understand when it comes to investments, we're comparing fixed income, and the insurance is a fixed income vehicle with very, very little risk. That's why I'm comparing it to fixed income. We compared it to a diversified portfolio before. Now we're comparing to fixed income. And if we compare to a fixed income vehicle, at age 85, what's the equivalent rate of return? We said is 4.88. But in fact, in order to equal that 4.88%, you would have to earn, if you were investing in a MIC, in a fixed income product, you'd have to earn 11.88% to equal the $14.5 million that's going to come out, that will come into your corporation. So $14.5 million comes into your corporation. Of that, the total amount of tax is about $700,000 of tax, because that's the adjusted cost base calculation. You end up getting $13.8 million back out of the corporation. So you put in 3.75, you let it sit until age 85, and now your family is going to get 13.8 after tax. The equivalent rate of return is double digits, 11.8. This is the asset enhancement. This is an alternative asset strategy where you're really not taking a lot of risk. How much risk would you need to take in order to equal the return and have $13.8 million? You have to be all the way through in that, you would have to be invested in an equity portfolio all the way through, taking equity risk to equal what the insurance is going to do. So that's our summary of the insurance. If it's at current, it's almost 19 million, and -1, it's 14.5 million. But let's throw the icing on the cake. What happens when a client says to me, I don't want to tie up my money in a 5% return. I'm earning double digits in my business. Why would I tie up $250,000 for an eventual 5, even if the pre-tax equivalent is 7.5% or 11%? Why would I tie it up? And the truth is, we have a solution where you do not need to tie up the money, and that is called the immediate finance arrangement. How does this work? You buy a permanent life insurance policy that has cash value. We showed you that a cash value is equal to 85% in year 1. By year 5, it's 100%. You can access 100% of the cash value in year 1. You can access 100% of the premium if you put up some additional collateral. But by year 5, even if you're not putting up additional collateral, you can access 100% of the money that you've put into the life insurance policy. You use the cash value as security. You borrow the money. The bank replaces the amount of the premium back into your corporation, which you deploy into either your business or investments. And when done correctly, and it's not complicated, under IT Bulletin 533, you can deduct the interest and what's called the net cost of pure insurance. So you're going to invest the money, you're going to deduct the insurance, and what happens is you have now reduced the cost of your life insurance because it's no longer $250,000. The cost of your life insurance is the interest on the loan. Actually, the cost of your life insurance is the after-tax interest that you paid on the loan. Let's take a look at what it looks like very briefly. You borrow your policy premium is $250. We're going to use the alternate dividend scale for how much we can borrow. So it's 208 instead of 211. You borrow that money, you have a shortfall of $41,000. By year 5, you're cash flow positive. There's no shortfall. You don't need additional collateral. By year 35, you've got a loan outstanding of $3.75 million. That's what you borrowed and you're paying interest on it. If you die, there is $14 million that comes in at the alternate dividend scale. It pays off the loan and you're left with $11.8 million. The internal rate of return is 6.84. Let me summarize it over here. Just $3.75 million loan. We're using our current dividend scale -1 to be conservative. So the death benefit is $14.5 million. The loan is 3.75. Net into the corporation is 10.7. So the corporation can declare a capital dividend of $10.7 million. However, remember that we have another $17 million in our other portfolio that we were talking about before. If you took the $250 and you deployed it into your portfolio, you'll have $17 million there. Because you paid off the loan within the corporation, you have unused capital dividend for that $3.7 million, which is worth another almost $1.8 million. So total cost of borrowing, you borrowed the money and you paid, I used 7% interest. Your total cost of borrowing over the 35 years on the loan was $7.3 million, after tax 3.5. And remember, you're going to save another $1.7 million on your CDA. And on top of that, you have the $17 million from your investment portfolio. When you borrowed that $250,000 out of your policy every year and you deployed it into the investment portfolio, that grew to $17 million. Plus the $10.5 million, the net is you have almost $28 million. So if you didn't use life insurance and you just invested $250,000, you'd have $17 million. When you combine the two in this immediate finance arrangement and you borrow the money, you have $27 million. And of course, we know that you had to pay interest on that. So that was $3.5 million. So your net really is $24 million. But cash on hand at death is $27 million. Remember, of that $27 million, $14 million is coming out of this, and $10.5 million is coming from the life insurance policy to come out to net to your estate. You've significantly increased your estate. That's what I have for you today. There are some other strategies that I can speak to, but I wanted to stop now, and I'll take any questions that we may have from the participants.
Thank you so much, Eli. This has been a tremendous session, and I truly feel you are enhancing the lives and increasing the effectiveness of Canadian business leaders everywhere. We have a great audience here today. We have about 100 participants on LinkedIn, as well as some here on the Zoom as well. So far, just great comments, no questions as of yet. But we can wait and see if opening up this hour, if anyone wants to pop their questions or comments in the chat, we can share them with Eli here. Well, and of course, if anyone does want to leave anything, they can certainly do so. We do have one question coming in from Tristan Laliberte. He says, borrowing rate, 7%. Is that representative of current conditions?
That's correct. The current borrowing rate is anywhere from prime to prime minus a quarter, depending on the banking institution. So what we've done is we've used current rates for the borrowing. If we were having this conversation a year ago, unfortunately, what you would be hearing a lot is insurance is free. You don't need to pay for it. You can borrow at 2%. It's great, yada, yada, yada. The reality is this strategy is not for everyone. This strategy is for business owners who understand leverage, understand that you're borrowing money. The interest has to be paid every year. You can't just be looking at the low rates that we had up until a year ago. We have to use the current rate, even in the low interest rate environment. As a firm that's been around a long time, we're extremely conservative. So when rates were really low and where borrowing rates were 2.5%, we would use 5%. Now we feel it's more appropriate to use the current borrowing rates in our example.
Terrific. Thank you, Eli. Mark Mielere. So we do have a question here. So at the age of 40, looking to exit my business, don't need the cash, and I'm looking for the best investment for my funds. What is the best strategy for $50 million of funds? Is this your recommendation?
That's a great question. And in reality, you really have to look at it in the context of the overall planning. So when you sell your business, let's say you're selling for $50 million. There's going to be tax immediately. Unfortunately, some of the recent strategies that were being used when people were exiting their business, those loopholes have been closed with, taking a look at Canadian corporations using some of the strategies where we could defer the tax. So there will be some capital gains tax payable immediately, but it will also create significant amounts of CDA. Now, usually when you sell the business, the money is going to be held in a holding company. I would definitely think that over time, although you've monetized, over time, we still are going to have to get money out of the Holdco to the estate long term. And so we would use part of the funds in the Holdco with using this strategy. And definitely, if you feel that you can earn a greater rate of return than the 7%, then we would use the IFA, or alternatively, we could just use it as an alternative asset class. I wouldn't say that we put all of the money in there, but it is a component. It is an alternative asset class, so it just deserves a sliver of the overall investment pie.
Perfect. Thank you so much, Eli. And the participant says, great, thank you so much as well. As a reminder, there is all these Deeper Insights webinars are recorded, so a replay of today's session will be available on the TEC Canada website. That's tec-canada.com, which will be up within the next couple of days. You'll be able to review this on your own time as well. This has been great. Thank you so much, Eli, for bringing these deeper insights to our community and beyond. It's been an honor and a privilege to be able to hear you speak with us today. And for everyone else that is attending, thank you so much for your participation and engagement here today. It truly does make these insights webinars that much more meaningful as well. So
yeah. Thank you so much. It's been a wonderful opportunity, but more importantly, it's just been amazing to be part of the tech community and has really added a lot of value. I'm sure many of our participants also being part of tech. For those that are not part of tech, you didn't pay me to do this, but what a wonderful organization. And this is just a testament to what we do.
Thank you, Eli. That's wonderful. And thank you again, everyone else. It was great seeing you all today, and looking forward to seeing you again next time.